Personal name or limited company? Which should you choose to build your property portfolio in? That is what we're going to be discussing in this week's episode. Let's jump straight into the video, and if you get value from this episode, it would help me tremendously if you lightly tap the like button, and if you're not subscribed already, you know what to do. Subscribe, hit the notification bell, and let's jump straight in. Okay, so why is this even a question that comes up? Well, it all happened a few years back and it's really come to the forefront because in 2021, the tax allowances have gone to shit. So originally, everyone had property in their personal name. Then they started moving over to companies because of Section 24. And now the going advice is you must buy in a corporate entity, buy in a limited company. Well, actually, strictly speaking, that's not true. It's really going to be dependent on your situation, and that's what I want to break down right now. So let's go through a worked example so you know what we're actually dealing with right now. So originally, let's take a property that you've got £1,000 a month rent in. £1,000 a month rent, and let's say you've got mortgage interest at £700. Okay, so that's your cost of your mortgage. Now, I know you might go, hey, it's probably cheaper than that, or some of you go, it's way more expensive than that. It depends on your area. But in general, hopefully you would agree that you are making, forget voids, maintenance, all of that. I'm going to keep it simple for the purpose of this video. You are making £300, okay? Therefore, £3,600 profit from that. And let's assume that you are a higher tax paying citizen in the UK, which is at 40%, then you are going to be paying 1,440 in tax. Therefore, you're making around, let's see if I can get this right, 2,160. That's a terrible 2,160 in your pocket to spend as you will. And that was kind of the situation that we were dealing with about 4 years ago. And then the government said, I like the way you're doing business, but I'm here to ruin your bloody day. And now you're not going to be able to count that as a legitimate expense, and shit's about to change. And I think the idea of this is because they want to push towards having it in limited companies. So instead of making it better for people in limited companies, they're making it harder for people in their personal names so that they can keep an eye on it. But that's just my opinion and maybe a bit of a conspiracy theorist, I don't know. So let's fast forward and look at the situation today. Okay, so if we look at the situation as is today, if we had that same 12,000 income over the year, and we've got 700 a month, which is 8,400 in interest over the year, but now the government will not count that as a personal expense. So instead, you've got to have 40% tax on the overall sum of the £12,000, which is £4,800 in tax. But what they are doing, and this is only if you're a 40% tax earner, which is why I want to give you this info and then maybe give you some guidance, you get a 20% tax relief. So you're going to get this 20% tax relief, we'll just put TR there, on the interest payments. Okay, so that's going to be 1,680 to come off of that overall tax, which leaves us with 3,120. So now what you're going to have is you're going to have 8,400 in interest payments plus 3,120 in tax, which is going to be 8, 9, 10, 11,520. So if you remember before, the profit, let me just do a before here. Before, we were making, what was it, 2,160? £2,160 net, N-E-T-T. N-E-T-T is after tax, 2,160. But because of this change came in, if you're a higher income tax earner, i.e. 40%, your new profit is going to be 12,000 minus the 11,000. Let's just put now on that. So nothing has changed here at all, apart from the government doing their job, you're now making £480 net in your pocket. Just because a change of legislation with the tax that the government, ironically, the Conservatives, have brought this in place that has kind of ruined the show for buy-to-let landlords. Or has it? Quick note on this, if you're a 20% tax earner, this is where it gets a bit interesting, because should you do it in a limited company or not? Before, at 20%, I won't go through the numbers, you can go back and watch it again, is £720 net. And because there's that 20% tax relief, it's still £720 net. Which is important to be thinking about in a moment. But essentially, if you're at the 20% taxable income or that bracket, it doesn't really matter. Your income's going to be the same before and after. So let's look at the same situation in a company, because you might be thinking, well, obviously you put it in a company, right? And for some of you, yes. For a lot of people, no. And you need to think about the average individual. So in a company, let's look at the numbers. So you've got your 12,000 still coming out, and then remember your 8,400 in there. That, remember, in a company is still completely tax deductible. So now you're making £3,600 profit in the eyes of the company, and currently corporation tax, again, we'll assume none of the other expenses like voids, maintenance, etc., just so we've got a like for like. And remember, corporation tax is currently, and I'll go through that in a moment, at 19%. What that means is you've got a tax on here of, what was it, £684. £684, therefore your, not profit, your net, remember NETT after tax is going to be your 3,600 minus your 684, which is going to be £2,916. That is completely different to the £480 in your personal, if it were done through your personal name. So pretty obvious that we should be going through a company right now, yeah? Maybe. So just some overall pros before we move on of being in a company. Number one is lower corporation tax at 19%. But just bear in mind, over the next 5 years, apparently, and it's not guaranteed, but it's likely to become 25%. But the thing to remember, corporation tax at 25% is only going to be above net profits of £50,000, which is really important, and we'll get back to that in a moment. The next thing is, technically speaking, you've got limited liability. What this means is when you own a property in your company, you don't actually own the property. And this is really hard for people to get their heads around, but I'll try and simplify it. The company owns the property. You, as an individual, you don't own anything. So I technically don't own a lot of property. My companies do. Okay, and then I own the companies. And that's really important because all of the liability and tax structure is to that company, which is a completely separate legal entity to me. Maybe another video on that, but not for now. Okay, but is there really legal liability or limited liability? Not really, because at the start of your journey, especially for the first maybe like 10 properties, if you're getting lending, they will ask for a personal guarantee, which legally ties you to the financially linked to that company. So if you screw up financially, they're still coming after you personally. So is there limited liability? Not so much. The final thing is there's slightly lower barriers to entry, and this is in the form of stress testing. So there's not as strong of a stress test. So, you know, your earnings are taken less into account, especially when you get moving, and the rental coverage is slightly lower with some lenders as you get more experience. The downside, two big ones that I think with a corporate entity like a limited company, is number one, the rates have gone down dramatically as more and more people are getting buy-to-let mortgages in company, but it's definitely higher. There's definitely a higher interest rate. Usually I'd probably take account of about 0.5% more in a company compared to what you could get to as an individual. So you will be paying that. and of course the added expense of accountants. More than likely you want an accountant as you're growing, and it's definitely more expensive, not dramatically, but definitely more expensive to have an accountant on a company rather than doing your self-assessment forms as an individual. So which one should you choose? Now this is the thing where it gets a bit different. So first of all, how much are you intending to make from property? And how old are you in the first place? Now that might sound a bit weird, but actually, if you're under that 40% tax bracket and you're using it as a retirement and you've got this pot of money, you're about to retire, how much money are you likely to be earning? Because if it's below around 50 grand and you're sort of that 20% tax bracket, which is actually slightly lower than that, then it's probably that you want to be in your personal name. Now, this is kind of different. If you're watching this sort of channel, are you looking to do what I'm doing and build a massive portfolio over years and years and years and years? Or, like a majority of buy-to-let investors, are you looking to have 2 or 3 properties? Because again, that's something that's going to really impact a lot of this. My gut is if you are at the 20% bracket and you're looking to do 2 to 3 properties, maybe you're looking to retire on that, my gut instinct is you probably are going to want to have those in your personal name. Something I really need to push forward that is a big deal, and I don't want to take it lightly, is I'm not an advisor. I'm not qualified to give tax advice. So please don't think of any of this as advice. It's just my personal opinion. So if you're looking at that level, you probably will be looking in your personal name. Whereas if you're looking to build a larger portfolio and you're above, let's say at that 40% tax bracket, and you're likely to be at that post-retirement, because if you're in your 30s, 40s, you might be working for a long time. But if you're looking to retire on this, i.e., you know what, if I'm going to get 40 grand net profit from this, then I'm going to quit my job. It might be worth thinking about your personal name, but you want to talk to an accountant about that. But if you are above that 40% tax bracket, probably, and you're looking to build that portfolio, you'll probably want to look at a limited company. Okay, limited company. The reason for this is a tax that most people don't think about, and that is dividend tax. A lot of people, they talk about company tax versus personal. The thing is, do you need access to the money at any point? So for me, I don't need to touch any of my rental income. I don't take any of that, well, technically, I don't take any of that out of my businesses. Okay, but what if you do need to take that? Well, you're either going to get charged 7.5%. You've got 2 grand as tax-free allowance, worth knowing that. But you're either going to pay 7.5% or 37.5% dividend tax on top of your corporation tax. So if you think you've got 100,000 and you've got 19,000 currently being taken from corporation tax, and then you get charged another 37.5, or ideally if you're smart you get your 7.5, so let's call it that, you're then going to get taxed a load more money. So again, it's less if you're here than the 40% you get taxed. But if you're anywhere near this threshold, again, it's a lot worse off. So people don't talk about that. It's all very well and good getting taxed a certain amount. But if you actually want to utilize that money, it's a very different game. And people talk about this on a bigger scale. So Cayman Islands, QNOPs, operating from Dubai, 0 tax. That's great. But if you ever actually want to utilize the money to buy your property and things like that, yes, it's still a smart move because you've deferred that tax. So as long as you are using that to build and reinvest and compound the effects of your interest coming in and your rentals coming in, then great. Probably keep it within the company. Just be aware you are going to pay tax at some point, which most people don't think about. So my overall verdict is, if you're okay leaving the money in there to get it working for you, if you are at that 40% tax bracket and you're looking to aggressively build a portfolio, you'll probably want to leave it in the company and build the portfolio within there. When you quit your job and it's at an age that you can still get mortgages as an individual, you might then want to think about getting a few in your personal name to take you up to just below that 40% tax bracket. So you can benefit from both having company purchases and individual. Most people will want a hybrid of that over the long term. If you are a 20% tax earner, let's say you're earning 25, 30 grand a year, and actually you're just looking for a job replacing income so you can live off of your property income and then quit the job, then you'll probably want to consider doing it in your personal name. So, which is better? I'm sorry, there is no black and white answer. It completely depends on your situation. What you need to do is take this information, plan out what you're looking to achieve over the next 5 to 10 years, look at your current tax and financial situation, run it by a tax advisor and accountant that actually knows what they're doing and can give you qualified advice and make your decision from them. But make sure you're talking to an accountant, looking at your finances, and most importantly, subscribing to this YouTube channel and smashing the notification bell. And if you got value from this video and you want to see some more like this, it would help me amazingly if you could tap the like button and let me know what you're going to do in the comments. Look at your situation. What do you think is better for you? Business or personal? I want to hear from you. And if you got value, check out this video.